we are absolutely certain that Goldman Sachs has long ago split ranks with the likes of JP Morgan and Citi. And Goldman Sachs are doing exactly what their sovereign counterparts and the Asian central banks are doing, which is accumulating as much cheap physical gold bullion as they can. And now, to put it crudely, Goldman is nobody's bitch. Word has it that they are cooperating with the Bank of England, who is readying for an inevitable gold price revaluation. Well, what the hell is that going to do to silver?
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And last night we heard Andrew Maguire dive deep into the silver world, mention that the 30 million ounces JP Morgan posted for delivery was part of a negotiation with the Department of Justice. Tonight he talks about how close he thinks this is to the break point, and if there's any particular levels, if it is silver getting over 20, and then we might see a gap up, how he sees this all unfolding. So I think you're going to enjoy what you're about to see, and here we go.
This is really this is a complete turning on the head of what we were used to historically experiencing over the years.
Yeah, I mean, you can just look at the charts and see something looks different. And Andrew, I think you mentioned you saw the call I did with Rick Rule the other night where he mentioned that they're taking metal in for their Sprott Trust every day. And I asked him, where is it coming from? And he said London. And as soon as he said that, again, my mind popped back to what you had mentioned. I think you sent that email June 1st to me where you said basically to meet the production or the demand, the refineries were switching over to gold. You thought you were going to get silver bars in July. Now you don't know when you're going to get them. So I was curious if you could reconcile what Rick is experiencing with what you're seeing out there, and basically if entities are going to, maybe we'll get into actually what a COMEX delivery is, but if people are going to be demanding silver, again, where is it coming from?
Yeah, well, where's it coming from? I think Rick mentioned that it's coming out of London. Well, certainly, yeah, it wouldn't come out. The reason it wouldn't come out of Switzerland is because there's VAT attributable to silver in Switzerland. So that would entail basically paying 7.5% VAT on what you're trading. And as a trader, that doesn't really make sense. And then because now you're trying to sell this on or fill an order, and people get caught. You can ship it out to, say, Germany and then ship it back in again, and you can claim the VAT back. But they're onto that, and there'll be massive fines involved. So no, it's not really coming. And the only real store of any silver, I think UBS probably sits on the largest store of silver, perhaps massive, 600 tons maybe. That's it. Now, obviously, storing gold in silver in London, it doesn't make a lot of sense because it's very high cost. So I think what we're looking at here is we're looking at this vault north of London, which is the SLV vault. It's a big warehouse. And as we know, with silver, you don't need a grade 10 vault. Gold needs to be stored in a grade 10 vault. Silver at this price can be stored in a grade 2 vault. Now that will change. That will change. Now, as silver gets up above $30, $35, insurance companies will start to demand silver stored in a higher grade vault. And certainly if you get to $40 or $50, it's uninsurable unless it's in a grade 10 vault. So that's going to create some real issues again for this whole situation with the SLV. It'll also create a situation for everyone storing silver in Brinks or Loomis vaults, which will also be mostly in grade 2. In fact, Loomis and Brinks are desperately trying to find grade 10 vault space. They've run right out of grade 10 vault space, and us trying to lease it from independent vaults like ours in Liechtenstein. So and are willing to pay a massive premium to do so. So it's just interesting. So yeah, I think if there's any bullion flowing, it is likely in outside of London, but it is UK, it's LBMA bars. But I don't believe for a minute that they're unencumbered. There is nobody is willing to actually physically sell this kind of bullion at this price. So there has to be leases involved, and certainly it's easier to hide these bullions. In fact, we talked about these massive spreads, the exchange for physical spreads, and what would stop you right now selling your off the board silver? Now you'd have to be an insider, because you cannot trade July silver as an individual, but as an insider you certainly can, and you would be sitting on there's 3,000 contracts still open or thereabouts. So you could actually sell that today at a 55-cent premium immediately by spot, and you will have arbitraged that. Yep. I think that's certainly what JP Morgan did, but I think also there isn't any physical to back these positions up either. And I don't think for a minute that what's sitting in the COMEX is actually physically deliverable without it being encumbered by some other warrant. So I think there's a whole religious experience about to occur here in the price of silver, because there will be a price where you could square a position, but I don't think for a minute you can square it at current levels.
Yeah, that makes a lot of sense, and I appreciate you mentioning that, because when, maybe Microsoft, there's some equilibrium in the market, but when you think, it's interesting when you think about silver, because I get, there's someone who leaves comments on my Twitter saying, well, there's no problem because the inventories are higher than ever. Well, if people are buying SLV shares and the demand is bringing it higher, that doesn't mean that, you're just going to be able to get it. People are buying, and, when you look at the people who buy silver, I mean, it's kind of funny, because as much as it's a great conductor of electricity and used as money, I mean, most of us silver bugs were big time hoarders, so I don't think it's like silver goes up $2 or $3 and the people watching this show are saying, oh, wow, it hit 22. I got to go out and sell everything. Which you touched on it a second ago just a little bit, but do you have any thoughts of how close we may be to a break point?
Well, I think we're seeing the first stage of it today. And I've always been very cautious about this, because basically there is still a lot of paper liquidity, or liquidity, it's not real liquidity, but we see a lot of paper liquidity floating around. But I think it's reached a point now where there is so much physical demand that the paper market is essentially what you're doing, let's face it, what you're doing is, if you short sell silver, like we saw yesterday, it's painted into the silver fix yesterday. And what happens? That's exactly where SLV is valued. So if you do that, but what you're doing essentially is, in the deliverable markets, the over-the-counter markets, the FX markets, the spot markets, where the silver fix is actually conducted, even if you could really get it for that price, which you can't, but anyway, we have to play the game here. That silver is really what we're saying. It's fake, it's unavailable at that price, but nevertheless, that's the price that is benchmarked. And I think what we're trying to get to here, though, Chris, is that the attempt to bolster back and to hang on for dear life to the last shreds of paper market liquidity, and to bolster this failing COMEX market, which it is failing. And I say, honestly, I don't believe for a minute that the COMEX in its present form can exist for much longer, given the amount of physical demand, unless it becomes a physical market. And that's exactly what the CME, smelling this coming up the road, they're attempting for dear life to restore confidence as a hedging mechanism. So you've seen it. They've moved to bolster, primarily talking about gold here. They moved to bolster registered inventories into this sideline 4GC loco 400 ounce bar contract. And they had to import gold from Switzerland to do this. I mean, really, but that contract immediately came under attack, and we're seeing that now. And after barely trading since its inception, this 4GC contract, we talked about this last time, and I know other guests probably have, but despite the BIS efforts to increase leased gold, which we think 100% certain came from Turkey, and we don't think they'll ever get it back, physical demand is so strong, this COMEX gold is being demanded for physical delivery in the plain vanilla GC contract. And this gold is about to be drained back into local London in short order. And we're seeing the same thing in silver. So I think last Thursday it was, with registered inventories being demanded for delivery, this 4GC contract, which was sidelined, the CME moved to authorize local London delivery of this contract. Now, this is just a desperation attempt, even though this contract's not even, I mean, we saw a few trades yesterday, but we're talking fives at a time. We're not talking hundreds and hundreds of contracts or thousands of contracts. It's going to fail. And it's far less friction to just exchange for physical or spot index, the tail wagging this physical dog price, and demand what is T+2 delivery in London. And none of these efforts are going to restore sufficient paper market liquidity to overwhelm these massive physical demands. Now, bottom line, I think this is what's happening right now, and this is why we're going to need some sort of price revaluation. The insider run K-Bal is, and Gata have been really good about detailing the actual, how this all runs and provenance for each link. A case in point, we are absolutely certain that Goldman Sachs has long ago split ranks with the likes of JP Morgan and Citi, both of whom happen to be agents for the Fed. Now, to put it crudely, Goldman is nobody's bitch. Word has it that they are cooperating with the Bank of England, who is readying for an inevitable gold price revaluation. Well, what the hell is that going to do to silver? Goldman Sachs is simply, what they're just doing, what they do is capitalizing on exactly what every other rational trader is doing right now. The fundamentals increasingly dictate that the price of gold, and that's the gold price in US dollars, is grossly undervalued. It's a no-brainer. From my discussions with liquidity providers on a daily basis, there will be no offers to sell any size of physical bullion below 2,200 to 2,500 bucks. And Goldman Sachs are doing exactly what their sovereign counterparts and the Asian central banks are doing, which is accumulating as much cheap physical gold bullion as they can. And Goldman's also expanding their LME physical bullion relationships. They're currently in negotiation to join forces with willing partners, seeking really to provide the much needed physical hedging services for these totally disenfranchised liquidity providers, banks, traders, who were burned by the CME on the 24th. And believe me, there's still a lot of losses being unsquared losses from these second-tier hedges that really are the liquidity for the COMEX. And that's why we're seeing real open interest, the real liquidity, the hedging liquidity that comes from legitimate transactions evaporating, to the point where we maybe guess 1.5%, maybe 2% if you're lucky, of any trades on an average day are anything close to real. They're just algo, battling algo, chasing around moving averages. But ultimately, there's a piper that has to be paid. Whatever the price determined on the COMEX is, it's actually ultimately deliverable.
Yeah, and Andrew, you mentioned something interesting there about how some of the banks are pulling away, which usually Wall Street is like maggots. Whenever a market's hot, they just can't, any way they can get involved. Yet here, gold and silver with what the Fed's doing, just starting to heat up. And I mean, for years, you've talked about it. I've wondered the same thing where what would be the signs when the scheme is about to end? Well, if the shorts ever got nervous and started throwing in the towel, and I mean, now that's happening. And especially if the people who were the banks that were shorting are leaving and meaning they're not going to short again. I mean, it puts a couple pieces in motion here. If they're not shorting, what's going to stop the price from going up this time?
That's exactly right. So then what we're seeing is really what bottom line, what we're seeing boils down to the physical market overrunning what is a deeply offside paper market. And it's a tectonic shift that's going to force even officials to revalue gold. I can see that. And it makes sense. And I believe Goldman's on the right side because they know that, that central planners, central banks are going to have to revalue gold higher. It's impossible that they wouldn't. And they may try and cap it at 2,500 or thereabouts. And maybe we'll see some resistance there. But to be honest, I think once you start to get above these 10, 15-year trend lines that have been capping gold and silver for so long, sideline money comes in. But I mean, we also looked at a myriad of drivers, that unprecedented drivers that would drive people into any physical asset, whatever it is, anything tangible. And that's what China's been doing. And China's been buying, divesting themselves of as many dollars as possible, buying infrastructure, forests, mines, anything you can touch, see, and something that's real, anything real. Gold and silver, of course, are part of that process. But yeah, so we're really seeing it's time to revalue gold and in a sense that drag silver as I say, drag silver, it ignites silver to a level which probably most people will not understand. It'll be anyone who thinks about starting to sell at 21.5, you'll see how quickly it rises into the 30s. And then once you get into the 30s, you watch how quick that thing moves. It'll take no prisoners. And so really, I think that the insiders that have been shorting and making and gathering, using COMEX futures to discount gold, silver, to get this physical in their possession, like this criminal enterprise that we've been talking about, that game is over. And I think it's time now really to let it go and be on the right side of it, which these insiders are on the right side of this.
Yeah, and when you mentioned silver and the $20, $21 area, I mean, again, in 2016, got over $20. Last year, got close to $20. And you talked about the trend lines and how people dig their heels in. Bart Chilton talked about all the stop orders and the trading activities that's around the handles, those big round numbers. I've heard people speculate that some of these derivatives, whether it's a Citigroup or a Deutsche Bank, that once silver starts getting in that 20 to 25 range, that things get triggered. And when you think about, well, someone's short all this paper, it's amazing that COT report, you see the 4 largest traders short about 300 million ounces. So someone's short it. And someone, at least based on logic, would be getting their face torn off if you do see silver really move. Is there some kind of gaps in there where maybe once it gets 20 to 22, it jumps up to 30 or something like that? Again, if we're really in that territory where you're close to a failure of more, I mean, I guess we've already had failures of these exchanges, but something more overt where people realize the metal isn't there. I've been of the mindset that you put enough leverage on anything, you can guarantee at some point you see some big gaps up. So any thoughts on that?
Yeah, and I mean, we're looking at, silver's been used to cap gold. We know that it's easy to use when you're an insider, a market maker. You can utilize silver also to cap gold. But we're seeing gold now breaking out. In today, we fixed at a level we haven't seen at this PM fix.
We now have $1,800 gold. We've been waiting, and today it happened.
Yeah, and so now we moved into the last fix at this level was September 2011. I mean, we're getting very close to where the breakout point is. I think shorts are spooked. Why wouldn't you be? You would now, if you were short this market, and you would definitely be starting to look at dips to cover. So I think we've moved from a sell the rally move into a buy the dip mode. And I think any dips from here on are going to be used by insiders to buy back positions, and as quickly as possible. Now, obviously, we already know that the likes of Goldman are already physically long gold in a big way, and are very, very happy for it to rise. In fact, they've been quite open about it, and usually we're very careful about Goldman. If they said in the past, when they've said they're selling stuff, they're buying it, and when they're buying stuff, they're selling it. But in this instance, we're quite certain. And the footprints clearly show that. The wholesale footprints really show that. So yeah, I think we are at that point. And to answer your question, I think 21.6 would be just a bit enough above 21.5, which is a round number. Round numbers always worry me a little. 21.6, you watch 30 come up really quick. I mean, really quick.
Well, I think there's a couple thousand people watching this right now that would be okay with that. Andrew, one last thing I wanted to dig into. We got a lot of questions about Kinesis since last month. So if you could provide an update on how things are going. And the other thing that I'll probably ask you this just about every time you're on, because I think it's that important. I mean, you've talked about SLV, you talked about GLD and why there's risk there. So just anything you can talk to on that part towards the audit things that are in place. I've been talking to you and also Gavin, who works on the project. One of the things that stands out to me is when I hear someone say, well, you know, we were behind on our launch because we were dealing with the government. We want to make sure we had everything in place, everything perfect, so no, even these bozos couldn't get in the way. So stuff like that, you know, to me stands out. All right, yes, there are people spending money, hiring lawyers to get all these things in place. And I think that's probably the main question on a lot of people's minds. So anything on Kinesis and you want to touch on there?
And I think this is why I'm so proud to be associated with this. I mean, basically, we always knew, we were under no illusion. The only way the paper gold sham would end, or silver sham would end, is when real physical demand forced discipline on the paper market actors, which is exactly what we're seeing now. The timing couldn't be better. This is why I'm actually so proud to be associated with this Kinesis monetary ecosystem, and it is a closed loop ecosystem. This is one of them. This is going to actually speed up the process of paper to physical significantly. It's all about liquidity. Now this is an exciting moment because we've just moved into the minting phase of the sequential rollout of this currency, and you can now become your own central bank. I know people have said that before, but not in such a way that this minting provides. It enables you to actually be a market maker and become actually part of the solution that will drive physical gold and silver priced in all currencies to unknown highs. It's all about being every buy to be backed by 100% by physical. And so through this newly introduced gold and silver minting facility, you'll be able to buy or sell or spend or trade gold and silver. But this is it. You'll experience the tightest spreads in the industry. It's not uncommon actually to experience spreads as tight as 1 cent between the spot gold and silver bid, spot gold spot gold bid and ask, silver bid and ask. Now, real allocated physical gold and silver in your name we're talking about here. We're not talking about some COMEX contract. So I would really encourage everyone to hop on the Kinesis Money website, open up a free Kinesis app. I mean, it's not going to cost you anything. Essentially, minting is the profitable process of creating your own Kinesis gold bullion and silver-based digital currency, which we call KAU for gold and KAG for silver. So a minter effectively becomes their own central bank, and you bring this new KAU and KAG currency, a Kinesis monetary system, you give life to it. And when you mint, or when these users mint the KAU or KAG currency, they purchase, what they're doing is they're just purchasing the underlying physical bars of allocated gold and silver bullion. And the newly purchased bullion, it sits in insured and independent audited world-class vaulting facilities, fully insured, with no storage fees for life. So this is a game changer. It has been a long time coming, but this is, to me, when I walked out of the DOJ with them saying to me, yeah, what about the economic consequences? We knew right then we had to do something. We had to find some solution. And thank goodness I walked into the likes of Tom Coughlin, who is the genius behind it, all of this, and created this massive team, which has now gone from strength to strength. So really now you can essentially own gold, no storage fees, and essentially you now basically can become your own central bank. So I would really encourage people to just go and look at it, make up your own mind. Tightest spreads in the industry. It's a no-brainer as far as I'm concerned.
Yeah, and the link to that is in the description field below. And again, also on the audits and where people can find out more information about that.
Yeah, that's all on the website. Everything's on the website. The audits are all on there. They're regularly updated as insurances are in place. And obviously, I wouldn't be associated with anything that wasn't one-to-one physical. We need to provide a solution here. Now, I could have sat back many years ago and traded at least 88 times and profited from it. I didn't do that because it's wrong, and it actually has huge real-world implications. And we saw that in 2008 when we saw mines being shuttered by this terrible bank, who is now being named as a criminal enterprise, when they took the Bear Stearns position, $21 odd, drove it down to 8.5, and put real people's lives, really messed with people's lives. And we even saw mines shuttered. We saw, and I know that we had evidence of people committing suicide in Bolivia, proud people who basically were generations had learned to do one thing, and that was silver. And this was silver in itself. And that really, really got me. And I'm really, really pleased that this is just one way. Stackers are doing it every day. And guys, thank you for everything you do. You don't sell anything when there's a dip, you buy more. So, you know, we're all part of the solution here.
Well, Andrew, I sure appreciate that. Appreciate everything you shared today. Another great one. I'm excited we're going to have you on monthly. I mean, because it's, you know, even I hope everybody does well. Don't do anything because I think it, do what feels right to you. But I mean, even aside from the investing, it's a fascinating piece of history that we're living through right now. And I know it's going to be exciting watching these prices go. And so with that said, thank you again for joining me, and we will look forward to catching up next month. And folks, go click on the link below, check out Kinesis, and we will keep you posted.
Thanks, Chris. Great to be with you, my friend.